Good afternoon, ladies and gentlemen, and welcome to this afternoon's Markets Now session, where we are going to be digging into a trading workshop on trading margins and availability. Long awaited, this one, I know. Good afternoon to you, Scotty D. Good evening to you, Matthew. Good to see you, man. Give it a couple, we'll give it one more minute. Let people get into the room, and then we'll get cracking on. Can I have a quick sound check, please, guys? I don't want to go off on one and then find out that I've been talking to myself, which I know happens good. Excellent. Sounds good. That's what I like. Hey, good afternoon. Alrighty then. We've got a big one today, guys. Going to be digging in. Lots of stuff. Supply and demand, liquidity pools, how to gauge the path of least resistance, defining entry targets and risk parameters. We got a lot to do. Before we do that, though, we will have a quick look at the markets. Going to do a quick review of today's markets conditions. Dig through. I'm not gonna bother, building the book and so on and so forth. It takes too long, but we are just gonna have a quick look. So, looking at the daily change so far, we haven't had anything that's been exceptional apart from Japanese yen and Australian dollar pairs. We have had some volatility from both of those currencies today. In terms of our indices, yesterday was pretty crazy in terms of the breakout liquidity that we did have in the US 30 Dow Jones. That was actually really nice breakout. Unfortunately, I didn't catch a dime on this one, guys. Not a single pip was taken out of that big breakout. I was waiting for the 1 minute retest of the liquidity break. It never came into play. And then for the majority of the afternoon, we actually ended up in a downward spiral here from up at the highs down to the lows. It looks so nice in hindsight, but I didn't manage to capture a single thing. My US trading session yesterday was made up of the NAS 100. Where are we? Yeah, made up of the NAS 100. Somewhere. Where are we? There. 1 minute time frame. So yeah, it was this and this. And it was relatively unimpressive. So yeah, they were the trading opportunities. Had a loss, had a win. So that was my US trading session yesterday afternoon. But yeah, I mean, looking at where the money is today, there's a lot of shorts going on out there at the moment. Equities are in big decline, I would say, for the most part. Tech services certainly taking a bit of a beating. Oracle's down minus 4.36%. Nvidia down minus 2.82%. Apple's showing a bit of a downward slope at the moment. A lot of grey neutrals there as well, but it is looking a lot more red/neutral than it is green/neutral. We got some decent movement in energy, minerals today, utilities, industrial services, kind of keeping afloat. Nothing too extreme. It's like mostly sitting around 1% growth. On the Forex side of things, look at the big daily change or loss. We've got a -8 Aussie yen. We've got Euro Oz 7.3. So yeah, I mean, it's as I said, Australian dollar and the Japanese yen really shifting things in the markets, but for the most part, not really seeing a great deal of anything taking place. It makes sense. We haven't got many market drivers. We're still living at the moment through the fallout from last week's Fed event as well. So we're not really seeing that follow through or big money moves as we like. Big money moves as we like from our economic data events or any other news for that matter. Today is the 25th. Yeah, 25th. Today is 24th. It is the 24th. It is the 24th. So 24th today. We've got no major events whatsoever. Fed Chair Powell's speech didn't really account to much yesterday, more than the Fed event did last week. We didn't really find out anything new. Tomorrow we do have DGO for orders, existing home sales as well for the US. Again, though, team, it's not really going to be market moving. And until Friday when we see the core PCE price index, and that's coming out at 1:30 in the afternoon. So that's basically where we're at for this week so far. So I think that's enough time. We will dig in officially to this afternoon's trading workshop then. Once again, good afternoon to everyone. Hope you're all doing amazingly well out there. And also good afternoon to you guys out on YouTube as well. Good to see you all. Good evening to you, Braden. Good to see you, buddy. And Cora Tim as well. So this afternoon, as you well know, we are digging into trading margins and availability. This has been a long-awaited trading workshop, and ultimately, we are going to show you guys how to identify available trading margins and basically, ultimately to decide if a trade is worth taking or not. Now, this is purely on the technical side of things. The only fundamentals that come into play here are ultimately our understanding of commercial money behind the scenes. But there's not really any fundamental analysis as per, when we're digging into the Fed or CPI or GDP and so on and so forth. We're not going to be digging into any of that today. This is going to be much, much heavily reliant upon technical analysis. Now, what I hope to achieve is for you to leave today understanding how to plot supply and demand zones and pools of liquidity in the markets, how to efficiently and effectively gauge your path of least resistance, to define your entry target and your, risk parameters, and then ultimately to evaluate the TRFs, which are the technical risk factors that are in play prior to your execution to determine whether or not this trade actually does not fit my parameters because of that TRF, but this TRF isn't so bad. Now, what is the actual thought process behind both of those technical risk factors? So, first of all, we're going to go through a little bit of a definition by the terms. I know some of you guys will know this like the back of your hand, so please bear with, whilst others, please soak up as much as you possibly can from these amazing definitions that I'm about to give. So, supply and demand zones. These are essentially areas in the market where we see a commercial change of hands in the money. So, for example, the market is rallying up in this upward slope here. We hit this area, which is when there becomes more supply of Dow than demand, and so therefore the price hits it and comes back down again, which then comes to this low. This then becomes our demand zone. So now we've been able to ascertain supply and demand. Demand in the market is where more buyers than sellers are entering the market for whatever reason, and this changes the course of the price action. And in this case, we're in an upward trend, so naturally the change of price action goes from being bearish to bullish, and then we go back up and continue on our trend trajectory. Now, in terms of liquidity pools, now this is in another term. You guys could probably be able to tell this by order blocks or periods of price equilibrium if you're speaking on the supply and demand side of things. And this is where you see the little intermittent areas of ranging price action. Doesn't always have to be little, but it is quite often. Obviously, we're on a 1 minute time frame right now, so I can already spot several in this chart. I can spot one which is right there, which is in here, which is where the market comes down. We rest for a period of time where money is flowing into the market, and then we get the break of structure and the big push up. And this happens periodically throughout the market, and this is where orders are entering the market prior to the breakout in whatever given direction the market wishes to go. Okay, and you can see these all over the place. Generally, these will happen at a period prior to a change in direction of the price action. So if we have a bullish period of price action up here, we come down, and then we can see this kind of mess down here. We can, we can call this mess, we can call it whatever we want, but ultimately it's the market going from side to side whilst orders are filling into the market and getting ready for its next push in the opposite direction to what was initially taking place. So we start from the high, we come down to the low, we rest, we start going high, we rest, we start going low, we rest, and so on and so forth. As you can see, this rest phase here is quite extended. And before and after this extended period of rest, we have an extended period of bullish price action, which then takes us above our supply zone up here. So now we've beaten the supply zone. We have the break, close, and retest. The bias would be a continuation higher. Okay. So that's pools of liquidity. Now, available margin. Again, in a technical sense, not a broker sense. This is price distance and room to move. And this is ultimately the space between the zones that we have to work with. Okay, so for example, we have, let's clear the chart down. We have this area down at the lows here. Okay, so this is our demand area. And I would say we have this area here up at the highs, which is our supply area. Your trading margin, and whenever I say that, is the space between these 2 points in time. Okay? Now, next up, the path of least resistance. What is meant by the path of least resistance? Now, the path of least resistance, let me try and find, I'm not going to try anything, I'm going to do it without a shadow of a doubt. So, hold tight. So the path of least resistance is ultimately this space in here. So it's the space between the top of this zone and the bottom of that zone. Now that is a path of least resistance for the market. Once we break through there, not before. Before is not, it does not have a path of least resistance, but above it, once we break through, is all path of least resistance. Why is it a path of least resistance? Because if you scroll backwards in time, there is nothing there at all. So clearly, it is a very nice path of least resistance. There is nothing that is going to potentially get in the way of this big bullish breakout. However, if we extend these zones forwards, we now possibly do not have a decent path of least resistance, because in our path from high to low, we have various elements of liquidity throughout here. Supply and demand zones, or pools of liquidity that took place on the trajectory to the upside. So now that was the path of least resistance is now turned into multiple areas that we have to navigate. And ultimately, it's quite a good segue into the fact that we have TRFs. Because now that we don't have necessarily the cleanest path of least resistance on the way down, these areas will be considered as TRFs, which are the last thing that we're going to be defining here today, which are your technical risk factors. Now, we cover this a lot day to day in the sessions. I will be quick firing trading opportunities out when we're building our book on a Tuesday, even today, or a Thursday. And I will say, okay, we've got a semi-decent path of least resistance or a relatively decent trading margin, but be aware we do have a TRF there, or we do have a couple of TRFs here. And I would usually highlight these by a horizontal ray. And that's what you guys would see. And what this indicates is not necessarily areas in the market that are going to lead to a stop out. They're not going to be major points of liquidity, major inflection points that are ultimately going to turn the market around, and we're going to be sat in something for 3, 4, 5 times as long as we initially intended. These are just areas that you can expect the market to have a bounce from or gain a reaction from. And the important thing about TRFs is not that you need any additional, not that we're fine-tooth combing our technical analysis here. It's actually from a point of psychology. And the major benefit of the TRF is to provide you confidence that you have a great understanding that the market will probably bounce from that area before it happens, and that the market will probably not take a big turning point as a result of it. So if I know that the market is going to bounce from 46.57 in front of us, this US 30 Dow, then that's going to give me the confidence to stay in the trade whilst it bounces, because I'm anticipating it to continue once the bounce finishes off at the next point up. And obviously in this case it does. We're hindsight trading here, so take that with a pinch of salt. But that is the idea of the TRF. It's to give you that good understanding of what probably will happen, so that you are not going to be concerned when you see the market starting to tick against you. Because I know a lot of new traders, and not even a lot of new traders, even traders that have been around for a few years, when they start to take, when they take a trade, let's say you're taking a short, your short's gone from, let's say you've got your short in your market there, you're looking to target down here at the lows there, just as we would regularly do at 46, 48, and that's your trading opportunity. Well, okay, if the market starts coming back on us like this, and we start to see big bars move against us, another big bar moving against us, we get happy, we get excited because we see a bearish bar, but hang on a minute, we've broken this high now. That causes a lot of psychological imbalance, and you start second guessing yourself. You start getting sweaty palms. You're thinking, bloody hell, this is going against me. I think I should get out. I think I should cut this now before I manage to take what I originally intended. You end up getting out of the trade idea, and I know we've all done this. We've all done it. I've done it. I've done this a 1,000 times, probably even more. And we all get out, right? We all take our profit there at the high, and we say to ourselves, we try and justify it to ourselves. I'm okay. I'm all right because I've got I got myself a 0.5 risk reward. I've got a little bit of money in the tank, and that's fine. Until you get to this stage where the market turns and it continues going down, and it continues going down and down and down and down. And then what you end up doing is you're thinking, okay, right, we've broken this floor. I'm going to wait for it to break this one back here. I'm going to get into the market. And then you end up taking another trade down here, and you've got your target profit there. You've got your stop loss in there, and you end up getting a 1 to 1.5 instead. So it's, and that's that's actually a really really nice example, right? Generally speaking, you get the trade at the end and it's like a 0.3 risk reward, or you take a trade right at the end and the market turns around and you get bit in the arse anyway. So that's actually a really nice hypothetical there, which rarely happens. So even though TRFs, look, even though they're not hugely, earth-shattering things in design, they seriously can give you such a good confidence in the trade that you're taking. I would recommend having a good understanding of where those potential areas are to everyone. So that is that. Now, what we are going to move into next, let me just double check you guys. Yeah, cool. So what we're going to move into next then. What we are first going to do is I'm going to run through the process of building a trading opportunity in the live market environment. And what I'm going to do is I'm going to use the US indices, and I'm going to do 2 birds in 1 stone here, because these trading opportunities, FYI, will be live trading opportunities ready to go for this afternoon's US Open. I don't want to take away from the workshop, but like I say, it's 2 birds in 1 stone. We might manage to make a profit whilst also having a workshop at the same time. Wouldn't that be nice? So let's build it out. First thing I'm going to do, okay, in the process of building the opportunity is I'm going to go up to my 15-minute time frame. My 15-minute time frame is acting in the US indices specifically. I use the daily time frame a great deal more in other assets, but when we're trading on a 1-minute chart, the 15-minute time frame is the anchor chart. This is where you can gain a lot of context around the market. Where is the true direction, right? Where are we in the broader sense? You just zoom out here and we can see that the US 30 Dow Jones at the moment is still trending higher, which is great. All-time high up there yesterday, 46.74. That's great. We've come back down for this big sell-off. We've been having a bit of a sluggish day today for sure. But I can see that we are actually coming into some areas of liquidity here. Look at where the price line is. The price line, if you don't have it on your charts, you need to get it on your charts. It's incredibly helpful, because wherever that price line is, if you go back in time, you can see wherever, there's clear points of liquidity, if there is any clear points of liquidity where price is currently trading, which in this instance today with the US 30 Dow Jones, there actually is. So the price at the moment is trading inside a supply and demand zone here. And technically, this is technically a supply zone. So the next thing I want to do, now that I've created that potential high, or possibly in this case, it might turn out to be a median, is I want to find a low. So we've got a high. Now what I'm going to do is copy and paste this area, and I'm going to bring this down, and I'm trying to mark out the sort of major structural points of the low. These are areas that the market has decided to change direction. So yes, of course, we all can see the floor, which is what we had in our charts yesterday, which is that one. But thinking about from where price is trading and yesterday with everything that happened, I don't actually fancy going for that one. And the reason here, again, and I've already outlined this for you, the reason I don't necessarily want to go for that low is because of what happened yesterday. Because yesterday we got the big market breakout. We eventually got a failed retest. The retest didn't actually, this collapsed through the top here, didn't amount to much because we came down to the middle of the available margin here, and then it reversed. So what I'm going to do based on the information that I had from yesterday's trading session is I'm going to bring this up and put that there instead. So now what have I done? Question. Okay, this is a question out to everyone. What have I done now? In very, very simple terms. Yeah. Matthew, you jumping ahead ever so slightly. I like where your head's at, but we actually haven't ascertained the path of least resistance just yet. But we have established an available margin. At least as Coritim very specifically has outlined here, it's a lower available margin. That's right, because we may end up looking at the margin above as well. So yeah, good job on that one, Coritim. But yes, that's what we've done. We have established a trading margin because now we have a zone above and we have a zone below. And the price action, although not technically trading in the middle, is still well within the remit of this trading margin. Now, on to what Matthew has said. The next thing we do, once we have the analysis carried out on the anchor chart, is we want to work out whether this margin has a good path of least resistance, because that's the next part of the process, right? We want to make sure that the price is going to have the capacity to travel freely within the margin that's become available. Now, as we're all looking at here, I'm sure we're all looking at this one together. We've got this area of highs. We've got this low. We've got this low. And we've got this low. So what we're going to do is we're going to grab another zone in here. And we are simply going to drag a thinner zone than the up. Wait, where's that gone? Okay, not sure what happened there. But we're going to drag a thinner zone through the middle. Okay, so now we've got upper, lower, median. Now, can anyone tell me anything that jumps out at them about the price action that we've got on the screen here? Let me make it even easier for you, right? Anything right of this white line. Okay, so let's start the white line there. So anything right of that white line. Is there anything that jumps out at you guys? Areas in the price action. Something, obviously in the theme of the trading workshop today, something that we've already discussed, specifically in the definition of the areas of the price that we're going to be looking at today. It's fine if not. You can simply give a thumbs up if you do with what you do, or if you don't, then a thumbs down. But I do want some answers, so get stuck in. Are there any? So, is there any area of the price action in front of us that jumps out at you? Certain patterns, certain contexts of the price action, something that we've actually discussed this afternoon in the workshop so far. Bearish flag. We haven't discussed bearish flags in this session. This is not candlestick fans, but I like it. Yeah, good for you, mate. Big moves away from that upper zone. Okay, yeah, I like that as well. TRF. We do have a TRF, yeah, which ultimately is the median of the range, the median of the trading margin. So yeah, I'll give you and Braden a combined point on that one. No one's saying what I see though. Okay. So what is this area in here? What's happening inside that area in there that's highlighted? Yeah, right on, man. Absolutely. We have the order fulfillment stage going on, don't we, down there? So the market has had this whopping big sell-off, and we get down to here and we have the rest phase, which is where the profit's being taken out of the table. So there's money flowing out in capital outflow, and we also have fresh liquidity going in and capital inflow. Capital inflow, capital outflow. And this is what happens behind the scenes when the orders are filling into the market, getting ready for something. Now, this down here, this proves, doesn't it, that this area down here is incredibly important. There is a lot of money in this area down here. There's a lot of money between 46.30 and 46.24, which means the chances are that the market could get down there again. So it's really good to be able to have a good understanding, a good vision for this stuff, because we can use that to our benefit when we're planning out our trading opportunities. Now, what we've also done, if we move further along here, let's just zoom this out a little bit more. Now, what we've got, what have we done to the original trading margin? And this is not trick. These are not trick questions. This is real simple, straight to the point. What have we done with our singular trading margin? We've cut it in half. Yeah, exactly. We've split it in half. So now we have what? What do we have now? 2. Yes, exactly. We have 2 trading margins. So now we've built everything that we can on the anchor chart. We know that there is a TRF / median of the margin in the middle, okay, which is really good. That's a great thing to ascertain here. And what we've also managed to achieve by adding in the median of our trading margin is we've now managed to gain 2 trading margins. So what we're going to do now is we're going to move down to the 1 minute time frame. And the 1 minute time frame is going to show us even more detail down here. It's going to show us a lot of magic, because instantly we'll be able to tell to ourselves, is this a good enough margin or is it not a good enough margin? And we do this by looking at the space. Now, this is, you can kind of, I suppose you could say this is a bit subjective, but I would say that this comes down to a sense of market common sense. Okay, so the more chart time experience you have, the easier this will become. But let's say, for example, that we have a trading margin of this in, let's just put a blind zone in. Okay, so let's just stick that there. Would anyone here say that those 2 trading margins on either side of this median, are they good enough? What about anyone else? We've actually got a good turnout today for the workshop. What about people who are being quiet? Unless you're working or driving. If you're working or driving, don't answer. But Abby, what about you? What do you think? And F, who's F? What's your name, sir? It's fine. I appreciate people listen to me whilst they're driving. I definitely don't want them to answer. That's fine. That's fine. Listen, we'll get back to you. But this margin, as you've rightly said, guys, it is too small. These are not sufficient trading margins, because we need to plot our path of least resistance. We need to be able to ascertain entries, targets, and all that stuff. We don't want to be doing that in a space that's so tight. So we delete this and we go back to our original 2. Now, these margins are absolutely fine, right? We've got plenty of room to breathe within these 2 margins here. So now what we have to do within these 2 trading margins is we have to build in the trade. So then we look at the breaker structure, we look at the entry. Breaker structure, entry, kind of one and the same thing at this stage. So, but this is all going to be taking away from the trading margin. So the break of structure point is on this one going to be here. Okay. The entry naturally slightly below. Now, when it gets time to put the trade panel up, this is where we ascertain the path of least resistance. Now, once we get the trade panel up here, we look left and we think to ourselves, okay, are there any TRFs? Right? Is there anything that is going to stand in the way of the price action dropping through the floor here and hitting my target profit at 46.31? Let's bring the trade down. Okay. Now, in this particular instance, the path of least resistance based on previous evidence. Okay, so this area from here to there, well, to there ultimately. Obviously, we're breaking out above now at the moment. We'll get onto that in a moment, but that's from where we are. And then back in time as well. We can see that there's, let's just drag this one back in time a little bit here. So that's pretty good. That's pretty good. Beats those highs as well there. So we have a potential TRF sitting at this area in here, I would say. An area that if price hits, as I've defined at the beginning of the session, an area that if price hits, it probably will have a bit of a bounce from it. I think it's going to be the turning point for price action? No, I do not. The turning point, as has been clearly defined by the use of our supply and demand zones, is up at 46.38 and down here at 46.30. So this is our available trading margin. We have this point of inflection here in the middle, which is where the market dropped down to, and then had a turn and going back up again. Ultimately, look, we'll get onto the market breaking out and we'll look at a long trade in a minute. But this is just a simple TRF. If we break the structure below this area here, I have every intention that the market will drop back down to that 46, 30, 31, 32 area. So that there is our trading margin and availability. We have been able to ascertain from the anchor chart our level of supply and our level of demand. We've also been able to split the margin in two, still leaving us with a successful trading margin and availability on the high and the low. We've also been able to work out that we have one singular TRF, which is going to potentially cause the market to have a bit of a bounce, but probably won't be the bounce that's going to take us out of the trade. So in terms of our stop losses, the stop loss, the stop losses are a bit of a science upon themselves. I would always try and have it a good margin above the breaker structure point and probably try to encapsulate as many of the highs as I can for this short. So for example, I can see that we've had this area in here and we've had a retest of it. And so if I pull that across to the side, pull that one back in time as well, the plan isn't to beat all of the highs. We're never going to be able to do that. But this area is an area of interest. It is a point of inflection. So if I can get that stop loss just a touch above there, that's great. And I'm yielding a 1 to 2.5. So now what I've been able to do is get a hell of a lot of protection for our short built into the stop loss and still manage to yield a 1 to 2.5 return out of that one as well, which means we're going to get a 0.6 return plus, which is great. And yeah, that's it. That's the entire process. So has that one in particular been clear? We'll do a few, but has that one been clear? Yeah. All right. So let's carry on then. Let's say we're looking for the high up here. We're looking for a potential breakout. And the next point, we're going to go back in time. That there is going to be interesting. The confusing ones are always good because they're the best to learn from. So that's fine. So what's this? Oh, I do apologize, guys. Just give me a moment. Got school calling. Yeah, I'm really sorry. I'm just in the middle of a stream. That's all right. No worries. I'll call you back in a bit. All right, bye. Sorry about that, guys. All right, I'm back. So, yeah, we've got the breakout level that we're looking for here. So that's going to be our new low. I was literally using the quote marks then, just remembered that no one can actually see me. So that's our low. We've now got a high, and the high is going to be here. Okay. And the reason it's going to be there is because we've had this point, but we've also had this point. And it's come right the way up there, stopped at that high, and then proceeded on its trajectory to the downside. Now, I'm going to take a pause here. I'm going to put the white line there, and I'm going to try and zoom this out. It's a bit scrunchy, isn't it? I wonder if we'll be able to ascertain those 2 points on a 15 chart better. Yeah, it doesn't look as clear, but it will work. It will work for this demonstration. Now, I'm going to highlight these two areas. One being here, which is what made me hesitate, and this one in here. Now, in everyone's view, why have I plotted the target zone or the supply zone at 46.48 here at this high rather than this area in here, which sits through there, which is undeniably an area of interest. Don't make no mistake, it is an area of interest. But why do you think I have plotted the zone up there for the TP rather than the one here? Anyone else? Thank you for your answer, Braden. I'll get onto that one in a moment. Wakey, wakey. Not enough coffee's been drank in this trading room this afternoon, I think. A retest of this zone before continuing down. Yep, that's fine. I understood what you meant. Yep. It has indeed, yeah. Because that one has been more recently used. Okay, yeah. Okay. So all three of those are valid reasons. I do want to say that. All three of them are valid reasons, absolutely. The one that is the most important one out of the three is the first one. Volatility of the move away from the zone. That is the key part of the process when you are studying the price action and when you are trying to be able to understand and move with the commercial money. What is the size of the move over here in comparison to the size of the move over there? Look at those two in comparison. Because number two has a move that is twice the size of this one here. And they are both moving into the same point of liquidity. The force in which the price action moved down after reaching this area was significant. And at the end of that move, we also had the order block form in the base as well, which is just an added level. It's just an added piece of confluence, right? But so that is exactly right on the money. That is exactly what I want to hear. Okay, so what does this level below become? Because we can't discount this level. It's an important one. So what does that become? Absolutely. That's the TRF for the long, or it is and can be recycled as a breaker structure for the short opportunity as well. To be fair, in this instance, I think if we go to the 1 minute time frame and we look at the available margin, let's tidy this up a little bit here. Right? We probably could say that there could be an early exit as well. I mean, if we really want to get sticky with it, right? Because if we have a TP at 46.46 and we have our stop loss at the 50% point between the breaker structure and the big liquidity down below, that's going to yield a 1 to 2.5. And at the same time, it's going to decrease our market exposure, our time at market. But what else? What last thing? Because a couple of things there I touched on, I did not define at the beginning of the session. So to stay on track with just what we're doing today in this workshop, what else do we have in, let me unscrunch the chart here for a moment. What else do we have in between these 2 points? If we look back in time, I'll just copy and pasted a shed load of zones. No. Sorry. So don't focus like entirely upon the circles. I've used them to highlight the points in which the price action has traveled, right? So then, we've got this area in here as well, right? So that's gone up and down and there. So what do we know from previous price action? What do we have? What have we made in here? Path of least resistance. Yes, indeed. Sorry, I may have been asking that in a cack-handed way. So I do apologize for that. But yes, the answer I was looking for is a path of least resistance. We have a path of least resistance now. Because the thing is, would we have the same path of least resistance if we were targeting at 46, 47? Would that be a path of least resistance? Without a shadow of a doubt? That's right. We would have it would be a relative POLR, but it wouldn't be the POLR, would it? Because we're trading into a relatively significant technical level. It's not the point of inflection, but it is a point of inflection. So in order to just fine tune that again, just bring that in once again, we can have that TP down just a little bit lower. We've still got a great risk reward ratio. We're going to be reducing our time at market, which reduces our market exposure and overall. And we limit our TRFs in the way of price action. There's always going to be some very small technical risk factors, but we're trying to ascertain the big ones, the ones that really mean something, i.e. the one above it, So then now we've worked out a really nice trading opportunity. So currently it's 16 minutes past 2. We've built in a really nice short for the US 30 Dow Jones. We've built in a really nice long for the US 30 Dow Jones, all using supply and demand, looking at technical risk factors, being able to ascertain our trading availability and margin, all using the characteristics of how we trade and what the focus of this trading workshop has been. So I'm going to do one more real-time example, and we'll do that in the NAS 100. So let's get going with it. So I am actually just going to drag those ones back. We'll use current price, of course. It's there. Okay. Right. So this is our price action today. So what we're going to do, we're going to head up to the 15-minute time frame. We're going to go to the anchor chart first. We're going to build a context. So, points of inflection, first of all, I would say these areas in here, these are points of inflection. We have another one in there, another one in there. So this is good. This is good practice for those of you who possibly are slightly new to this and you want a better understanding. Go and mark out the beginning of a move in price action with a red circle. So the beginning of a move here, the beginning of a move down, the beginning of a move up, the beginning of a move down. Well, I haven't done that one myself. Beginning of a move down, beginning of a move up. You go through and you mark them all out. And then you'll be able to understand better where to place your zones in. So we could have a zone there, for example, and you'll place a zone there. Now, you may get a bit off put by this low that's come into play here. But what does that become? If now we have a high and we have a low, which has been clearly worked out on the anchor chart, what does this low become? A TRF. Yeah. Sorry, Braden. What do you mean bottom of the margin? What do you mean on that one, buddy? Oh, right, a trade to that one. Well, we don't have the margin for that one though, do we? So if we go down to the 1 minute time frame here and we look at the available trading margin, we don't have the margin to take a trade to there. So what that's going to be is a TRF. But also, the interesting thing about this, it could also be construed as the top of the median of the range. Right? So if I have a zone that's about that wide, then that's the median, isn't it? Right? Sits right bang in the middle, slap bang in the middle of these 2 points. Sorry, I thought you were referring to the zone in the chart. My bad. Yeah, no. That's fine. That's fine. So that's sort of what we've got to work with. Now, we've been able to ascertain where the sort of points of interest are on the 15-minute time frame. Now we're down on a 1 minute time frame. This is going to be a really good example for you guys as well because it's not clear as day. Do you believe that these are sufficient trading margins or not? What do you think? Based on the the recent bit of price action here, just looking at that from a just eyeball it. Okay, cool, yeah. Cora Tim, Scotty D. Anyone else as well if you're there? Matthew, no? Okay, good. Good. You're all damn right. Absolutely. I wouldn't be trading in there. But it's not clear as day though. Because some of the price action, I mean, if you look at some of these moves, you might do. It's on the edge, isn't it? It's very, very close. But no, you are right. I would not want to trade in those margins. So then we have to move on, don't we? We either move on or you have to make an executive decision of your portfolios if you want to take on that market exposure, if you want to take on that additional risk. You would then see this area in here as a TRF, and then you would have the opportunity to look for an aggressive entry with an aggressive breaker structure. But honestly, guys, I'm for this in live environment, I'm literally talking about trading this in 15 minutes time. Well, actually in 9 minutes time, whatever. But that breaker structure in there, which is the only one above this, it doesn't work for me. I don't like that. I feel like I'm too much trying to cut corners. So I will have to leave that alone. So even though this margin initially looks great, really nice big sweeping moves in here and stuff, I'm actually now that I've built it out a bit, fleshed it out, I'm not too much of a fan of that anymore. So I'm going to steer clear of the NAS 100 short today. So then what we're looking for here is we're actually looking for a retest of this area. And now what we need to do is we need to copy and paste this one. And we need to bring that up to where we believe the next high is going to be. Now, this is, without a shadow of a doubt, the main high, right? We've got that point in there, which is ultimately going to reflect a TRF. But this is the area that I anticipate the market coming back to. It's where the supply has been overruled by demand. Where demand has been overruled by supply multiple times. The market's coming back down now as a result of failing to break and close above it multiple times over. Now, looking back in time, we need to get ourselves a breaker structure point. Don't really have too much in terms of clear breaker structures. So probably going to utilize this space in here, which is where the market's come down, rejected, come down, rejected. So we know that it's a point of interest. Anticipate the market coming in here first, and then on the rejection from our big zone in here, back up to the high. Now, in terms of TRFs, we definitely have one, team, and it's not small. In fact, like the short, that is quite a significant level. Really, isn't it? We've got this W reversal, the base of it. We have a second base of a W reversal in here. And as we work our way along, we can see the markets come back to retest it a few times before actually continue on its given trajectory. The market actually was sustained by this level for a great period of time, from 8:54 this morning all the way until this afternoon, until 1 o'clock. So it doesn't fill me with a great deal of confidence either. I mean, the long is actually looking incredibly like the short. So maybe in this instance, and it's funny that we're doing the workshop this afternoon and we get this, but I think I would probably prefer to stay clear of the NAS 100 this afternoon. We have two absolutely more than viable trading opportunities in the Dow Jones, and both of these are going to potentially yield a 0.6 return, which I'm going to be absolutely fine with. You know, you do one of those every day, you're going to be up a few percent per week. Per year, you're going to be doing incredibly well. So I don't think there's any actual reason to look at that. And it's been a really good exercise to carry out, because by studying the price action, by using the tools at our disposal, looking at the supply and demand, the pools of liquidity, the technical risk factors, the trading margins don't make sense. And so that's why we stay clear and we keep our money in our accounts where it's safe. So that's why I'm going to leave. I'm going to leave it there. I'm going to wrap things up there. I think that's perfect. So we have managed to successfully navigate the US 30 Dow Jones this afternoon. The entry and target mechanics were carried out absolutely fine. We've been able to utilize our points of supply and demand and study the market for those areas of liquidity that we anticipate the price action to go to or move away from. We've looked at stop placement above or below those points of those structural points, but also if you can manage it above areas in which the price action has reached previously as well, just trying to build in as much protection as possible. And we've also been able to determine what makes a very good path of least resistance versus not such a great one. So are there any questions, guys? Any questions at all? Or are you happy? No problem at all. All right, team. Well, I'm going to wrap things up there then. We got 3 minutes to go for the US Open. Let's hope we make a few quid off these Dow. But listen, it's been a real pleasure as always. I have enjoyed doing the workshop, so I hope you guys have managed to take something away from it too. I appreciate a lot of you who will probably be watching this on catch up over the next couple of days as well. So take care of yourselves. Have an awesome rest of the day. Good luck in the US Open, and I look forward to catching you all tomorrow for the US Open session and a book building day as well. So take care, and I'll see you then. Thanks, guys. Bye-bye.